Have you ever felt like the economic news is some kind of secret code? Well, today on the Journeyman Podcast, episode 53, we're going to break that code wide open for you. We're going to take a deep dive into a whole stack of information you shared with me and really try to untangle what's going on in the stock market lately.
Yeah.
We're going to zero in on how these trade policies could be the real key to it all. And we'll even explore a pretty provocative theory about what might be going on behind the scenes. By the end, you'll have a way clearer view of how all these complex pieces fit together. If you find this kind of analysis helpful, make sure to hit that like and subscribe button. That way you won't miss out on any of our future deep dives. All right, let's get started.
So looking at this material, something that really jumps out is the way everything seems to be connected. It's not just isolated events. It's like this chain reaction. And trade policy, it looks like it might be the real trigger for all the market chaos we're seeing.
Definitely feels like we're tracking the source of an earthquake here. And it seems like the first tremor started with those trade disputes between the U.S. and Canada back in early 2025.
Yeah.
So let's rewind a bit and see how it all began.
Yeah, the timeline is really important here. In February 2025, the U.S. slapped tariffs on a bunch of Canadian goods.
Okay.
10% on energy imports, and then a big one, 25% on a whole range of other products.
Wow.
The source material says Canada was really concerned about this.
Yeah, understandable, right? I mean,
Yeah.
25%, that's huge.
Exactly, not a small thing at all.
And Canada's response in March was pretty decisive. They didn't just sit back and take it.
No, they didn't. They fired back with their own 25% tariff on American imports. And here's the kicker. They also added a surcharge on electricity exports to the U.S.
Ooh, interesting.
Yeah, so now the uncertainty was even worse because both sides were upping the ante.
Right. And then the U.S. escalated things even further. They decided to double the tariffs on Canadian steel and aluminum to a whopping 50%. I can't even imagine how the markets must have reacted to that.
Oh, yeah. That kind of aggressive move is bound to send shockwaves through the markets. Investors just hate this kind of unpredictable policy stuff.
Makes sense.
Yeah.
I mean, how are they supposed to plan or make any kind of predictions when things are changing so fast?
Exactly. It completely throws off their forecasts and risk assessments, and then almost out of nowhere, there was a partial reversal, right? They put the increased tariffs on Canadian steel on hold temporarily.
Yeah, because of all that pushback from American manufacturers.
Right.
Why was that such a big deal? What made them change course?
Well, it shows you just how intertwined the global economy really is. Those American manufacturers, they rely on imported steel and aluminum to make their products.
Of course.
But when those prices suddenly skyrocket because of the tariffs, it messes up their entire supply chain, it drives up their costs, and in the end, it really hurts their bottom line. So this whole backlash proves that protectionist measures can seriously backfire and actually end up hurting the very industries they're supposed to protect.
Fascinating. So it's not just the tariffs themselves, it's that ripple effect, the uncertainty that really rattles the markets.
Yeah.
Because predictability is key for investors.
Absolutely. They need some stability to make informed decisions, and all this rapid-fire policy change just erodes their confidence.
Totally. If you want to dig deeper into these trade wars, we'll put a link to the source material in the description below.
Yeah, good idea.
So it seems like the real problem isn't just the direct impact of the tariffs, but that broader economic uncertainty they create. And the sources we've been looking at point to another factor that's amplifying this problem, the whole idea of Doge firing.
Yeah, that's a strange term, isn't it?
It is. What exactly does that mean?
So Doge firing, as the material calls it, basically means major job cuts in the government sector.
Okay.
And the idea is that when you have lots of people losing their jobs in government, it shrinks the total income for households across the country.
Right. Less money coming in.
And less money coming in usually means people are going to cut back on their spending.
They got to tighten their belts.
Exactly. And then that can impact company earnings, and you can see how that would lead to even more market instability. The source mentions the cancellation of government credit cards.
Really?
And a noticeable drop in airline travel as signs that people are already spending less.
Wow. It's incredible how all these economic factors can interact and influence how the market's feeling. And then we get to this really interesting theory that suggests maybe these events aren't just random accidents.
Yeah, this is where things get really fascinating. The material you shared actually brings up the possibility that President Trump might be deliberately trying to cause a market downturn.
Hold on, really deliberately causing a crash. Wouldn't that be risky? Why would he do that?
Well, the theory is that he's trying to put pressure on the Federal Reserve to lower interest rates.
Okay, I'm following so far, but I don't quite get the connection. Why would a market crash make the Fed lower rates?
It all comes down to the massive U.S. national debt. which according to the source is sitting at an unbelievable $36.5 trillion.
That's an astronomical number.
It is, and trying to manage a debt that big is incredibly expensive when interest rates are high. The interest payments alone are supposedly bigger than the entire annual defense budget.
Wow.
Yeah, so lowering interest rates would take a huge load off the government's shoulders financially.
And it could give the economy a boost in general, right? Because
Right.
borrowing would be cheaper for businesses and consumers.
Exactly. It could encourage more investment and spending. And then when you consider that over $9 trillion of debt is coming due this year, that's a lot of pressure to refinance.
So the theory is that by creating all this economic anxiety and maybe even pushing us closer to a recession, the Fed would feel like they have to step in and lower rates to calm things down.
Precisely. It's like creating a problem so that you can offer the solution.
Clever, but risky. But here's the thing. According to the source, the Fed didn't lower rates at their meeting in March, even with all the recession fears swirling around.
Right. So maybe this wasn't the plan after all, or maybe it just hasn't worked yet.
It's a complicated game, isn't it, with a lot of moving pieces.
Mm-hmm.
And in the middle of all this talk about potential market doom and gloom, the sources also mentioned some good news, strong production figures coming out of the U.S. That seems a bit contradictory.
Yeah, it does, but the source is cautious about those numbers. They suggest that businesses might have intentionally ramped up production in anticipation of those tariffs.
Makes sense stocking up before prices go even higher.
Exactly. They'd want to build up their inventory before those imported parts become too expensive. So what looks like a booming economy could just be a temporary reaction to the trade situation.
So the big question is, are these figures a real sign of economic strength, or are they just a blip on the radar?
Exactly. Time will tell, I guess.
With all this volatility and potential for more market swings, what kind of advice do the sources offer to investors who are trying to navigate this uncertain landscape?
Well, they highlight a few key strategies. One of the most important is that historically investing during market downturns has often led to the biggest gains when the market eventually recovers.
Yeah, I've heard that before. Buy low, sell high.
Exactly. But that requires a long-term mindset and the ability to ride out those short-term dips.
For sure, patience is key. But what about someone who's new to investing? What are some concrete steps they could take?
The source suggests looking into index funds, especially ones that track broad market indexes like the S&P 500.
Index funds. Okay.
They offer instant diversification across a bunch of companies, and they're a pretty simple way to get involved in market growth without having to pick individual stocks. You can usually get into these through a brokerage account or online investment platforms.
That sounds relatively straightforward. And for more experienced investors who are comfortable with a bit more risk.
The source suggests doing some research and finding individual stocks that might be undervalued right now.
Okay.
They specifically mention medium to large cap companies with a good track record of paying dividends. Those could offer higher returns, but they also come with more risk, so you need to do your homework.
Makes sense. And this all really underscores the importance of thinking long term.
Absolutely.
Market corrections, even those big drops in value in bear markets, those are normal parts of the economic cycle.
It's true.
And while major crashes are less common, they've always been followed by periods of recovery.
Exactly. It's important to remember that market fluctuations are normal.
Yeah.
They don't necessarily mean the whole system is collapsing.
Right. So don't panic.
The source also highlights dollar cost averaging as a good way to manage risk.
Could you explain that a bit for our listeners who might not be familiar with it?
Sure, dollar cost averaging just means investing a set amount of money at regular intervals, like every month, regardless of the current price.
Yeah.
This way, you're not dumping a ton of money in at the worst possible time when the market's at its peak over time. This strategy means you'll end up buying more shares when prices are low and fewer when prices are high, which can give you a lower average purchase price per share in the long run.
That's a great strategy. So let's recap our deep dive today. We've gained some valuable insights into how U.S. trade policies, especially with Canada, have been a major driver of recent stock market volatility.
Yeah.
This is largely due to the economic uncertainty they create. We also explored the fascinating theory that these policies could be a deliberate attempt to force the Fed's hand on interest rates, mainly because of that huge national debt hanging over our heads. We also examined why those seemingly positive production figures might not be all they're cracked up to be.
Right.
And we discussed various investment strategies for navigating these turbulent times, stressing the importance of a long-term perspective and strategies like dollar cost averaging. It's like a complex landscape, but hopefully you're feeling a bit more informed now.
You know, connecting all this back to your goal of staying informed, Understanding these forces at play, like the relationship between trade monetary policy and market reactions, that's really crucial for making sense of the economic world we're living in now.
Absolutely.
And if you're interested in even more analysis and different perspectives on these topics, I'd recommend checking out the Neil McCoy Ward channel and maybe even subscribing.
Yeah, that's a great suggestion now as we wrap up. Think about this. What do you think will be the biggest factor shaping our economic future? Considering all the tensions around trade, the possibility of deliberate market manipulation, and all those constantly changing economic indicators, it's definitely something to ponder. And if you found this deep dive helpful, take a second to like and subscribe to the Journeyman podcast. That way you'll be in the loop for more explorations into the information that really matters. Thanks for joining us.